right, well, it's For Your Money Wednesday, and for most of us, following basic money rules is the path to success, but as everything unfolds here, there's exceptions.
Yeah, knowing when to break the rules apparently, and when to break a money rule. That can be key to long-term financial success. Here to tell us the rules that we might need to break is Andy Mattingly from Forum Credit Union. And I can't wait, because you're saying it's always a smart financial decision to pay off your debt, except when it isn't.
It may not be. If your debt is something that gives you a tax advantage or it's for an appreciating asset and you haven't fully funded your retirement, you might be better off putting more money into your retirement instead of getting your debt paid off. Because in the long run, you'll get tax advantages and you'll be saving for your retirement. So you might need to break that rule in that case.
Now, should you always pay off debt with a high interest rate?
Most of the time, that's the way to go. But if your need is really that you want more money, more cash flow, then you want to look at the one with the largest payment and not go with the one with the highest interest rate. So it depends upon your situation there.
And then there's the rule, okay, saving 10% toward retirement. Is that a good rule to follow no matter what?
That's a good rule if you're under 30. You can get away with going with 10%. But if you started later and you're over 30 and you haven't been putting in 10%, or you want your lifestyle to be different than what you are currently living and you want a greater lifestyle, you're going to need to put in more than 10%, so you need to break that rule.
So would you suggest maxing out that employer-sponsored account?
Most of the time that's a good idea, but you also need to look at your employer account and see if it offers the advantages of like Roth contributions and things like that. So if they don't offer those, and depending upon your tax situation, you might want to look outside your employer account after you meet the match.
This is a rule I wasn't even aware of, but 2.5 times your income is how much you can spend on a house. So do you stick with that rule?
For, where that rule comes in is just to give you a good idea of where to start looking at house prices and things like that. But if you have student loans or other debt, or maybe you're thinking about moving in 5 years, you're going to want to bring that down and buy less of a house so that you'll be better off in the long run.
Another big factor here, kids. You have a baby. What is the rule on saving for college for them?
Well, a lot of people will tell you that as soon as you have a child, start saving for their education. And that's a good rule to follow. You'll probably have a lot of their tuition covered. But if you haven't started saving for your retirement, start that first, because there is no way to fund your retirement. Once you're retired, you can't borrow in retirement to fund your life. So you need to get your retirement going. You can pay for your kids' tuition with loans, or maybe they get scholarships, things like that.
All right, so emergency fund, is it always best to just put that in a normal savings account?
No, once you've got 90 days worth, then start looking at other options. Most of the time, people don't need all of their emergency fund right away. So you put it in, cash for 90 days that you can pull out. You put the rest of it in other investments because you're going to get a higher return. And as you need it, you can pull it out. So in the long run, you'll be a lot better off.
There you go. The
Always
rule
food for thought.
breaker over here, Andy Mattingly. He said it, not us. Thank you so much. We appreciate it.
You're welcome.